We continue with our discussion on financial management under valuation of bonds. And one of the topics that typically covers fixed income securities and investing is the risks that are entailed in fixed income investing. Now, broadly speaking, there are multiple risks that manifest themselves when someone invests in a bond. But the primary risks that anyone faces are three in nature. We will list down those risks here. The first one is what happens to interest rates when you have invested in the bonds, because you remember that interest rates and bond prices are inversely proportional. So if rates go up, you could lose money on bonds. So what is the view of interest rate and how does the interest rate risk affect us is what is important while looking at bonds. The second is the fact that the bond carries a credit risk. What is a credit risk? The risk that someone does not pay, also known as, in other words, default risk. Right. So the scenario is that someone has borrowed money, and there is a fair probability that this money being given does not come back. This is covered under credit risk. Finally, there is a risk of inflation. Uh, Inflation risk can be construed as if you invest 100 rupees in something and you get a return of 100 and of 5%, that gives you 105. The value of this 105 next year may be different from what the value of 105 today is. It's quite possible that what you are buying next year is expensive as compared to what you're buying today. So inflation has to be factored in the returns, and your actual return in real terms thus becomes lower than what the return is denoted by the bond, purely because usually inflation is in a positive territory and erodes the value of the currency that is available. Right? We'll look at each of these in more detail as we go along. Uh, and we will also try and find a measure of how do we actually capture and calculate some of these risks or quantify some of these risks, and can we find that and can we kind of use that while investing in bonds, right? So let's first take interest rate risk. We know that interest rates are kind of inversely proportional to prices of bonds. Why does that happen is, let's say if interest rate increases in the economy, then all existing bondholders will also require a higher interest rate, right? So the yield required by the investor increases. We have already seen that as yields increase, or yields wanted or yields required increase, price of a bond is a factor of the cash flow divided by the yield required. And if there are multiple cash flows, the yield is always in the denominator. So if the yield required increases, automatically the price of the existing bond will go down. We could also look at it this way. Let's say Government of India introduces a bond today that gives you 108 after 1 year, right? Now, you bought this bond for 100 rupees today and it'll give you 108 after 1 year. Now, 3 days down the line, Government of India introduces another bond that gives you 110 after 1 year. Now, what will happen? The entire demand will rush towards this second bond, which means there is no demand for the first bond, which means the prices of this bond will start falling in order to compensate for the lower demand and higher supply. Everyone wants to sell this bond and buy this one because this is offering a bigger amount, right? So effectively, if interest rates in the economy increase, the yield required by existing investors increases, thereby bond prices go down. The exact converse is also true, which could act as an opportunity sometime, is if interest rates go down, if interest rates decline, then bond prices will go up, right? Take an example. Consider a 6% 20-year bond. This is going to give 6% every year. This is offering 1% premium to the market interest rate. Let's say interest rate in the market is 6%, is 5%. Uh, if you look at what's happening, is required yield by investors is 6%, let's say, and this bond is trading at $100, right? Now, what's happening is rates in the market are 5%, and this bond is offering 6%. This is a bond that, given the risk, gives 1% higher return, right? It's offering a 1% premium to the market interest rates, right? Let's take the example as, let's say this is the RBI rate and this is the rate by a company like Tata Motors. Obviously, RBI rates or Government of India rates will be lower than the company rates because company risk is higher, right? Now, at this point, the price of the bond could be 100. Now, if RBI increases the rates, obviously the company will also have to increase the rate offered, because otherwise people will start moving towards the RBI bond, and the extra 1% has to come in to compensate for the risk. Once this extra 1% comes in, automatically the price starts falling, it starts selling at a discount. If on the other hand, the RBI cuts rates, plus 1% premium for the bond gives you 5.5%, that takes the bond at a premium, right? So the bond starts selling at a premium immediately as interest rates decline in the market, right? Let's take another example, and let's say if we can measure this entire interest rate sensitivity or risk, there is a concept called duration, more appropriately something known as modified duration, that effectively gives a measure of price sensitivity to the changes in yield. Right now, if the yield changes by 1%, how much do you expect the price of a bond to change? That is effectively the quantification of the interest rate risk, right? Now, duration of a bond, as I said, more appropriately, we should construe duration as a term called modified duration. Exact definition of duration is a little bit complicated, and we leave that at this stage. Exact calculation of duration is also something that is a little bit complicated at this stage. So we will stick to our simpler definition of interest rate risk sensitivity, which is called modified duration. Modified duration of a bond gives us a measure of how much the bond price will move by 100 basis point. 100 basis point is equal to 1%. So 100 basis points is equal to 1%. When the RBI says they are changing rates by 25 basis points, they are effectively changing the rate by 0.25%, right? So 25 basis points is equal to that. So duration of a bond gives us a measure of how much the bond price will move with a 1% movement in yields. An approximate measure of this can simply be found by just changing the YTM of a bond slightly, right? We have a bond price equation, and we'll try and use this in an Excel file to understand how this works. And when we change the YTM slightly, obviously the price will change. How much difference does that change bring in the price, right? Let's look at an example and that clear things out. Assume that there is a bond with a coupon rate of 8% and a tenure of 5 years, annual pay bond, it pays only once a year, face value of rupees 100, and expected return or yield of 7.2%, right? Can we find the current price of this bond? The price should be NPV of the bond cash flows at 7.2%, right? The cash flows at 7.2%. That should be the price that we should be able to calculate, right? Let's look at the Excel file and try and see if we get the price, and then let's try and see if we can arrive at a measure of modified duration using those calculations. So this is the bond we are talking about. Effectively, we are saying that it's a 5-year bond. It pays a coupon of 8%, which means 8, 8, 8, 8, and in the final year, 8 plus 100 because the face value is 100. The discount rate is 7.2%. That's the YTM, that's the yield. And if I find the present values of all these cash flows that's available here, we get a price of 103.26, right? We can also calculate the same price using the NPV function. NPV rate is 7.2%. Values are given here, and you will see we will get 103.26 once again, even when we calculate it using the NPV, right? Now, you see the small note here which talks about what is the change in yield going to be, right? So let's change the yield slightly by 0.1%. In other words, by 10 basis points. If we change the yield by 10 basis points, 7.2% should either become 7.1% or become 7.3%. Let's try both and let's see what happens to the price change in either case, right? So let's look at what happens if the price goes down to 7.1 if the yield goes down to 7.1%, the price changes to 103.68, right? What I will do is I will copy this and paste this as values here. 103.68. We decline is effectively when yields decline by 10 basis points, right? We increase will be when yields increase by 10 basis points, right? So yields increasing by 10 basis points would be 7.3%. Price goes to 102.85. I'll again copy and paste this as values. This is when yields increase by 10 basis points. That's this value. And let's go back to our 7.2% value so that we reach the initial stage, right? Now what we see is the values that are available with us. Can we find out what is the change in price, right? How do we find change in price? Change in price divided by the initial value, correct? So in the first case, that's 103.68 minus 103.26 divided by 103.26. And let's look at the second case as well. This would be 102.85 minus 103.26 divided by 103.26. And let's convert these both in percentages, right? And what do we find? We find that with a 0.1% change in the yield, when the yield goes down, price goes up by 0.4%. When the yield goes up, price goes down by 0.4%. So 10 basis points here changes the price by 40 basis points. In other words, we can say that if yields change by 1%, prices should change by exactly 4 times that, 4%, and in the opposite direction. Opposite direction. Why opposite direction? Is because yields and prices are inversely related. This is on minus 0.1%. This is on plus 0.1% change in the yield. So effectively, we are saying that with every 1% change in the yield to maturity, you will have the bond price approximately changing by 4%, 4 times of the change in yield, right? That is what is called as modified duration. If you want to put a formula for modified duration, or you want to name the, quantify this number, in this case, modified duration will be 4, approximately 4, right? So when you say or hear that modified duration of a bond is 6, that means that if you change the yield of a bond by 1%, the price will change in the opposite direction by 6%, right? If modified duration is 2, the same change in price for every 1% change in yield will be 2% either direction. Remember, this is an approximate formula. As you keep increasing the yield changes, 1%, 2%, 3%, 5%, you will see that the approximation becomes less and less accurate, right? For small changes in yield, this works. For large changes in yield, this formula will start giving slightly distorted results. But usually interest rates don't change very dramatically. So for all practical purposes, this simple calculation using the Excel file is good enough to find out what is the modified duration of a particular bond. And a simple change in modified duration will give us the values, right? We could try this with another example very quickly. Let us assume there is a bond that gives you 10% as the coupon. So obviously the coupons change, and let's assume discount rate here is 11.2%, right? That gives the current price as 95.59. Now let's change this 11.2 to 11.1, and you see 95.94. Let's just copy and paste this as values. You change this to 11.3, we get 95.23. Control C. Let's just paste this as values, and we go back and put our initial value of 11.2%. We find that for this particular bond, a 10 basis point change in yield brings a 37 basis point change in the price opposite direction. What is the modified duration? With 10 basis points, you're getting 37 basis points. With 100 basis points, you will get 370 basis points. 100 basis points is 1%, which means this should be 3.7. Your modified duration in this case is 3.7, which means for every 10 basis points of change in yield, the bond price will change by 0.37%, right? That's how you calculate modified duration of a particular bond. That's an example of the interest rate sensitivity of a bond. The textbook calculations are slightly different. That's a slightly more complicated way, and theoretically speaking, you first calculate something called as duration and then arrive at what is called as modified duration. You could use that as well, which will eventually arrive in the same, almost the same number. But that's more useful when we're looking at more complicated stuff. For simple calculations, this formula of modified duration works absolutely fine, right? So that's the first risk that we calculated. Now let's move on and look at the other set of risks that we find. Right now, when we look at the other set of risks, the risks that come out in terms of credit or default risk are the next set of risks, which is the risk that the issuer of the security does not repay either the interest or the principal in part or in full. This is also known as default risk. Right now, someone borrowed 100 crore but did not pay the entire 100 crore, paid only 80 crore, right? That's called as default risk or credit risk. There are ample examples of companies that have suffered default risk, and it becomes very, very difficult for someone who's buying a bond to otherwise calculate this. For these purposes, how do you measure this? There are various global rating agencies that come in. These are known as credit rating agencies. And what do credit rating agencies do? They look at the fundamentals of the companies who are borrowing money, their history, the business they are in, their capacity to pay the money, and they try and quantify what risks exist with respect to the company's default chances, right? So how probable is a company of defaulting on its loan is what these credit rating agencies basically talk about. Now, there are many rating agencies in India, companies like CRISIL, CARE, ICRA, Brickwork, right? And what ratings they give in the bonds is given next. There are global agencies as well, S&P, Standard and Poor, then you have Moody's, you have Fitch. These are global rating agencies, right? Rating agencies basically come, look at a bond, look at the fundamentals of a bond. So what will they check? They will look at the fundamentals of a company. In effect, they will come and do a financial statement analysis of a company and try and find out what is the capacity or capability or ability of a company to repay debt, right? Ability to repay debt. If the ability is high, if the safety is high, it is given as the safest rating. If that is not the best, then it is given as the least safe rating. There are various rating categorizations that come in, and there is a nomenclature that is used in terms of what are these ratings that are given to various bonds. When you look at a bond, a rating will almost always come with the bond, and that allows you to understand whether a bond is risky or less risky, right? So let's look at what are the credit rating agencies and what kind of rating formula or format do they use, or symbols that they use. Let's look at CRISIL. CRISIL is an Indian rating agency, and they give about 8 different ratings starting from AAA, AA, A, triple B, double B, B, C, and D, right? AAA is the highest safety, right? This is effectively close to government bond yield, right? So obviously, if a company's payment capacity is considered supreme, it will be accorded a AAA rated bond. So for example, companies like Infosys, if they ever issue a bond, will probably come at AAA. right? Because it is almost certain that they will repay the money. There is no chance of them defaulting, or very, very less chance of them defaulting. This is considered as the highest safety. As the safety measures decline, right? High safety, adequate safety, you keep declining the ratings to double A. Then you have moderate safety, which is triple B. Below triple B, typically, you have slightly riskier securities, right? So inadequate safety, risk prone, substantial risk, and default. D is also known as junk category. At this, the default risk is highest, and your claim is almost as good as a stockholder. You are most likely not going to get paid your debt. Then there is a substantial risk in bonds which are rated C. The risk declines as you go up, right? So your risk is declining as you go upwards, right? Logically, if risk is declining, the expected return also declines, right? Take a simple example. If there are two companies, company A is Infosys, who comes to you and says we want to raise money, and company B is some random ABC company which we don't know about, and they come to you and raise money. Same loan amount, let's say 100 crores, same tenure, let's say 2 years. Who is it that you will ask the higher interest rate from? Right? The risk is higher here. And because this is risky, your expected return from this would be higher. You would want to get compensated for taking that extra risk, right? So effectively, AAA rated bonds will have the least yield, and lower rated bonds will have higher yields as you keep moving in that spectrum. Another rating agency called ICRA rates almost a similar rating profile, just that you have a small prefix L that comes in for ICRA, and then CARE basically puts a prefix of CARE. CARE is another rating agency. A bond could be valued by or rated by multiple rating agencies or one rating agency. Usually, you will find that there will be a fair degree of overlap in terms of the processes they use. And if a company has been rated AAA by CRISIL, it is most likely going to get rated AAA by ICRA and CARE as well. So if, let's say, Infosys comes for a bond and CRISIL rates them AAA, then it is unlikely that ICRA will rate anything significantly different from AAA. Maybe AAA could become AA and somewhere in between here, but you wouldn't have a bond that is rated AAA by one company and triple B by another. That's very, very rare, because one or the other company will then sit up and take notice of what is going wrong in this essentially. Why is another rating agency rating it at a different level than us, right? Between these, there are, remember, quantifiable parameters. So sometimes you could have a company that is slightly better on the AA parameters, but not good enough to go into AAA, right? Then you sometimes add a suffix at the end, which is AA plus and AA minus, right? So in risk terms, or let's put this in safety terms, AA plus is greater than AA, which is greater than AA minus, but all of these fall in the same bracket of quantifiable parameters, that is AA. They are not good enough to move into AAA at this point, right? A company's rating, when it improves, also look at it this way. Let's say a company's rating improves from triple B to, triple B to A and then to AA, right? If rating improves, then we are saying risk goes down. If risk goes down, effectively we are saying that yield required will go down, which will mean that bond price will effectively go up, right? So if a company's risk profile improves, you will see a bond price of that company going up. The exact opposite is also true. If the risk profile deteriorates, you will see the bond price falling for that company. This is credit risk. A company need not default completely. Even if the rating reduces from AAA to, let's say, A, you will see that the bond price will fall. And when the bond price falls, you will obviously make a loss on the capital part of your money invested that is there, right? That's credit risk. That's how you get quantifiable credit risk by various rating agencies that companies use. And that's the risk. How do you look at a bond and look at the risk that is associated with that kind of a bond? The third risk that we talk about is essentially inflation risk, which is risk of decline in value of a security's cash flow due to inflation. What is inflation? Rising prices, or in other words, falling value of your currency, right? Falling value or purchasing power of your currency. Let's say an investor purchases a bond with a coupon rate of 6%. Inflation rate is 4%, right? Now, if you think about it, 100 rupees invested will become 106, but the value of this with 106, you will not be able to buy what you were buying with 100 earlier, right? The value of this is going to be 106 divided by 1.04. Why? Is because 1.04 rupees now is equivalent to rupees 1 last year, right? That's because of the 4% inflation that has happened. Now, because of this, what will end up happening is your 106 is worth only 106 point by divided by 1.04, and that would approximately be equal to 102. You'll find that this value works out to about 102, right? And hence, this return is known as the real return or effective real return. Your nominal return is what is quoted on the paper, right? Nominal return here is 6%. Inflation, however, eats up into the real return. So the real return approximately is 2%, right? Approximately. How do we actually generalize the real return? Let's look at the real value. You're saying that every rupee is now worth about this much. Last year, 1 rupee is worth 1.04 this year, right? Effectively, or this year 1 rupee is equal to 1.04 last year effectively because there's a fall in value. So what you could buy with 104 rupees last year, or with 100 rupees last year, sorry, you'll have to pay 104 this year to buy the same stuff. This is last year and this is this year, right? So if you have 106 rupees now, effectively the value of that 106 is 106 divided by 1.04, right? Let's try and use an Excel file, and when we use the Excel file we will arrive at the formula of calculating 1 plus real return. Effectively the value we will get is going to be about 1 plus 2% as we solve this equation, right? Let's go to the Excel file. When we look at this value, what we are saying is that my real return is effectively 106 divided by 1 plus, sorry, the inflation should be 4%. So we see 101.92. If I had invested 100 rupees, effective value of the 106 that I made at the end of the period, right? So nominal value of 100 rupees invested is 100 into 1 plus 6%. That's the nominal value I get. But real value, or let's put this as real value, that's 101.92. Real return is going to be this divided by 100. So that's about, right, and remember minus 1. So that's about close to about 2%, 1.92%, right? We got an approximate value of 2%. We can now try and generalize the formula. If you want to get to this number, you can also calculate the real return using the formula we just saw. So let's just write down the formula for our ease. We are saying 1 plus the nominal return divided by 1 plus inflation is going to give me 1 plus the real return, right? So let's calculate that. 1 plus 6% divided by 1 plus 4% is what we are trying to solve, right? Let's put that here. That's equal to 1 plus 6% divided by 1 plus 4%. And remember, this will give us 1 plus real return. So from this, we will have to subtract 1. We'll have to subtract 1 to get to the value that we just calculated. That's 1.92%. right? That's what we just calculated. Now we could use this for any set of data. If you have a bank FD that gives you 8%, but you have an inflation that is 6%, your real return is effectively lesser, right? Your real return is effectively lesser. Your real value obviously will have to become, in this particular case, 108. So let's put that as the nominal value divided by 1 plus 6%. And you see that the real value and nominal value start differing now. And that gives you the real return. One is calculated using the formula that we just saw on the right side. The other is calculated by dividing the nominal value by 1 plus inflation, which is the same thing. We're essentially doing the same thing in both the cases, right? You could have a scenario where your nominal return, a bank deposit gives you 8% and inflation is 9%, in which case, on a real basis, you are losing money, right? That's the next risk that gets quantified when you're investing in bonds. Essentially, your real return could be different than the nominal return that the bond suggests. And that is because the inflation starts acting up in between, right? The formula to calculate the real return is given as 1 plus real return is equals to 1 plus nominal return divided by 1 plus inflation. An approximation of this is real return is equals to nominal return minus inflation. That's an approximation. It works for smaller inflation values like 6, 7, 8%. But if inflation is like 20%, then this will start giving distorted results, right? In our example, 6% minus 4% gave an approximate value of real return, which is 2%, right? That's the final risk that we saw of investing in bonds. That is the inflation risk that comes out, right? That's all the risks that are available in terms of investing in bonds. That's where this particular video ends.